Hello, I'm David Lin, and welcome back to the Kitco Insights interactive series brought to you by Coin Payments. Are investors about to witness a major market crash this year? Well, the first month of 2022 has been defined by fear. Fear of rising inflation, which has been at the highest level in 40 years. Fear of the end of the zero interest rate era. Fear of the persistence of COVID, and fear of heightened geopolitical turmoil all around the world. Markets and in particular risk assets have certainly reflected this fear and uncertainty and doubt. For example, the VIX index, a gauge of fear, has climbed to multi-year highs. Now, the big questions on investors' minds today: is fear here to stay? Is this the end of the bull cycle for stocks? Are we about to see market pivots? And importantly, is 2022 the year of capital rotation out of risk and into safety? Our expert panel today will address these concerns and give their investment outlook for Bitcoin, the crypto markets at large, the stock market, and precious metals, and of course, the biggest market themes of 2022. Joining us today are two very special guests, regulars on the show on Kitco. You've seen them before if you've been watching our show, Lyn Alden and Gareth Soloway. Lyn Alden is a macroeconomist with an engineering background. She founded Lyn Alden Investment Strategy in 2016. It is a newsletter for investment research, and since she's founded this firm, she's made a number of very important correct calls, including recommending to her subscribers to buy Bitcoin when it was at $69,000 only. She has since been featured as a guest speaker at some of the world's most prominent crypto and macroeconomics events, including at the B Word not too long ago, where she was speaking alongside Elon Musk, Jack Dorsey, and Kathy Wood. Gareth Soloway is the other panelist. He is a pure technical trader. He likes to avoid the hype and has made a number of correct calls on this very program at Kitco. In October 2021, while he was with me in Dubai, he said that we should not trust a breakout in Bitcoin above $65,000 and that we should be careful for more downside and a deleveraging event, sending Bitcoin sharply lower. Well, Bitcoin has done exactly that. In addition, in late December, he called for gold to be the best performing asset in 2022. So far, he's been right on that call as well. Gareth has been trading for a number of years, 20 years, more than 20 years to be exact, and he is so far one of Kitco's most popular panelists for a straight-up approach, telling investors how it is versus how they want to hear investment calls. Well, Gareth and Lyn, welcome back to Kitco. It's a pleasure to have both of you. I've never had both of you at the same time, let alone at a live interactive event. So welcome. It's my honor.
Thanks for having us.
Yeah, thank you.
And for the viewers watching, we will, of course, be taking live questions from the audience, but we'll be going through my questions first for Lyn and Gareth. About 40 minutes in, we'll be taking Q&A. And Lyn, Gareth, feel free to obviously talk to each other and ask questions to each other. You're more than welcome to play host, if you will. So let's start with the crypto markets at large. Bitcoin obviously not had a great year. Bitcoin has had the worst start of the year out of any year since its inception. It's lost 31% as of today, wiped out more than $214 billion of value. So let's begin. What happened this year so far? Lyn, I'll start with you.
So in general, Bitcoin is showing risk-off behavior, kind of an early sign for the market. So it started to show weakness before the other indices. And my base case is I thought this rally probably had more legs to it, that it would stabilize a little bit better, but we've seen that that's not really been the case. And we started to get that confirmed in economic data. So for example, if you look at the past four major rallies in Bitcoin, so 2011, 2013, 2017, and 2020, it's coincided with rising PMIs in the United States, purchasing managers indices, basically economic expansion and acceleration. And it's generally had its bear markets coinciding with periods of economic weakness. And so as we enter 2022, the problem is that PMIs are kind of rolling over. And so we don't have a gigantic sample size to work with. It can potentially decouple from other assets, but in practice, it's been a risk-on asset more often than a risk-off asset. And so I think it's somewhat challenged here, along with other risk assets. It's kind of been correlated to like the either large cap tech stocks and particularly the ARK style kind of unprofitable growth stocks. They peaked back in February of last year. And although Bitcoin's given been say it's given better 2-year returns than those ARK stocks, it's still generally had a similar shape to a lot of them, and so it's been under pressure, I think, for similar reasons.
Gareth, what's your view?
Yeah, so I agree with Lynn. I mean, what's interesting about it is there's a couple coordinated things. For instance, 2017, we saw Bitcoin top out about a couple months before the stock market. We've seen that again here. In addition, you could see how the decline that started from that 69,000 was really leading a lot of these, like Lynn mentioned, the ARK style, C Limited and some of these other plays, Cloudflare, they've all collapsed now. I actually think that based on just the other day, in fact, yesterday, I called a short-term bottom in Bitcoin based off a major kind of technical retrace. So just one of the little tidbits I'd love to just throw out there to investors is if you look at the April high to the low that hit in June before we ran up to 69,000. So the 65,000 high to the 29,000 low, the exact that distance, that dollar amount that it fell was just replicated as of yesterday when we went from 69,000 down to 33,000. So just on a short-term basis, again, I'm someone who thinks Bitcoin eventually is going to head lower. I think sub 20,000 is likely, but just in the near term, I do expect a bounce maybe back into the low 40s.
Okay, low 40s. So that's your medium-term call. Now, Lynn, last time you were on the show, about a couple of months ago, you said your medium-term outlook was, well, you said that the indicators pointed to more bullish action than bearish. Are you still sticking to that view?
So after the price weakness, I think that it basically on-chain indicators are suggesting kind of neutral to bullish, where basically they're showing signs of kind of capitulation, kind of it's in value territory relative to its generally on-chain indicators. And I think that's contrasted by the fact that the macro environment is still challenging as far as I look out through the rest of the year. And so I think it's kind of playing ping pong between those two forces. Basically, the way I described it is that demand peaked back in quarter one, right? So back when ARK stocks topped, when Bitcoin had a big local top, and basically ever since then, the demand side has been weaker. What's been holding it up is that it has a tighter supply dynamic than prior bear markets so far, meaning that the combination of basically dollar cost averagers and you also have, say, miners holding a larger percentage of their own mining production. That's been a common trend, especially among publicly traded miners. Basically, the supply side's tighter than normal. And so the kind of way I've been describing it, it's kind of like dry kinder. So the supply side's very attractive, and you could get supply squeezes, but it's really hard to have a sustained rally until you get more demand, and that's traditionally been associated with risk-on environments. Because I'm not very particularly bullish on equities this year, my base case is that Bitcoin probably chops around for a while. I don't have specific price targets, like if it'll break below the 30,000 mark or not, or if it'll go above 50,000 again this year. My overall kind of base case is intermediate term neutral. I think there's a lot of variance for what it can do, while still being structurally bullish over a multi-year period, probably coinciding with the next risk-on period.
Well, let me just ask this one question, and then I'll let you guys respond to each other. Gareth, your downside target, you've recently told me that you've downgraded your downside target to below $20,000. You said that before it could touch $20,000, but now you're saying it could go even lower than $20,000. Can you state your case? And I'd like to see if Lynn agrees with you.
Yeah, so the couple things that kind of bother me is, number one, you have the stock market that's only fallen now. I mean, the NASDAQ's down, 15% or so, but the S&P is not even down quite 10% as of today. And you got to think that equities, and I think Lynn mentioned this, is that you probably do have more downside. So the question is, if you see equities correlating with a certain percentage downside move on Bitcoin in a de-risking environment, does that push? I mean, we're already at 36,000. We just hit 33. It's not a stretch to think that we could flush down. And another thing that kind of bothers me is that, every cycle on Bitcoin, it's been basically an 85% drop. Now, again, cycles can change. We know that. But you have to kind of say to yourself, if that 85% drop does come in from 69,000, that brings you down to about $10,000. I'm not sure if I think it's going that low, but you have to factor that into your thought process. And lastly, I'm still in the camp that the internet bubble, the dot-coms, and I traded through this. This was my beginning years of trading. It's very similar, right? You had dot-coms that were pennies at one point, like Dogecoin, or sub pennies. They would literally go up 200, 300% a day to the point where they were multiple dollars in terms of these companies. And you got this bubble. It was a new technology, just like blockchain. There was so much hype around it. And then you had this washout. And again, Amazon at that point was $100. It went to $5. So you had this massive decline. And ultimately, we've seen Amazon rip higher, right? And it's become one of the biggest companies in the world. So longer term, I mean, years out, I think it's hugely bullish for Bitcoin and Ether and these other ones. But I still think we need to see a washout of these meme coins. I mean, there's so much junk in the space. And it's hard to imagine that washout occurring unless we get a bigger move down sub 20,000.
Okay. Lynn, do you have a response to that?
So I generally agree we need to see a washout of a lot of the meme coins and the altcoin space broadly, anything that doesn't really have fundamentals behind it. And I think that could take the form of time or space. So if Bitcoin corrects downward, it obviously puts a lot of pressure on those usually. But also, I mean, if Bitcoin grinds sideways, if it just becomes like a bear market for like a year where it just kind of goes sideways, a lot of those other tokens drain out value. So for example, Dogecoin peaked back really early in 2021, it's off tremendously from its highs, even as Bitcoin basically had this big choppy sideways pattern, even managed to touch slightly new highs later that year, whereas Dogecoin bled out. And so I think you could have an environment like that. I think my overall base case is I'd be somewhat surprised to see a sub 20,000 print. I don't rule it out as an option though. The one way I would describe it is that, Bitcoin's had these 85% drops in the past, but also had massive blow off tops in the past. And most of the indicators show they didn't reach the same level of exuberance in this cycle. So basically, you're measuring it from a less extreme topping point. It had more of that rolling top than a huge spike. Basically, the market I think is more mature. So I would be somewhat surprised to see a sub 20,000 print. The environment that I can imagine getting there, if I would have put on my bear hat for a second, it would basically be that the Fed's tightening, or at least talking about tightening into a declining PMI environment. And if they do so when we saw Bitcoin after the prior bear market, it started to stabilize above 6,000 after hitting 20,000. In 2018, it was stabilizing at 6,000. But when you had that late 2018, Powell like autopilot, tightening into the declining PMIs, that's when you had Bitcoin collapse to nearly 3,000, right? So, and you had massive kind of liquidations. And so I basically, I think if you have a liquidity event, if you have credit markets freeze, if you have some sort of major event like that, I could see a very illiquid Bitcoin spike down. I think barring that, I'd be somewhat surprised to see a sub 20,000 sustained level.
All right. I have a few charts to show you and ask you about. So the first one here shows the Bitcoin price versus the hash rate, which is the total computing power in the Bitcoin network used to mine Bitcoin. Now, in the past year, we've seen a close correlation between these two variables. Ever since November, this correlation has started to break down. You see in the blue line is the hash rate. It's continued to go up while the Bitcoin price has gone down. What does this divergence mean? I mean, there's two ways to interpret it. One is that this divergence means that this correlation no longer holds. Hash rate is no longer relevant to predicting the price. The second interpretation is that Bitcoin is severely undervalued and oversold. What's your take?
I'll jump in just with mine, and then Lynn can go. But I mean, what I noticed on this chart is, right, you had the biggest divergence to the upside on that when you were making that euphoric high, and then essentially that's greed. So greed is pushing the price above that hash rate. And then on the other side, now you've gotten into this fear. So a lot of people, when I was talking about downside when we were at 68, 69,000, they said, well, on-chain analysis doesn't say that, right? But the response to that was just simply, it doesn't matter in the near term when you have fear take over. Fear is the most powerful emotion, and it will trump everything. So I think that's really what you're seeing there, in my opinion.
There have been debates in the Bitcoin community if hash rate leads price or price leads hash rate. Fundamentally, it's hard to have, basically, Bitcoin miners, they bring capacity online when it's profitable for them to do so. And they can look through short-term periods of lack of profitability. But if it becomes unprofitable mine, they start shutting off the most inefficient machines. And so right now, it's still profitable for many types of miners to mine Bitcoin. Initially you had supply chain shortages when it comes to chips, right? So that limited how much hash rate could come online. And so it became unusually profitable to mine Bitcoin. Then you had the Chinese miner migration. Basically, they did a more effective ban than prior quote unquote bans. And there's still marginal hash rate in China kind of under the radar, but a lot of the big farms had to obviously move out their equipment. And so we've seen a migration of hash rate to North America in particular. And generally, it's still profitable to mine at this level. And so I think that basically as long as it's as profitable to do so, that hash rate is going to continue to grind higher. You would have to have a some sort of major downward price to start slowing the hash rate. And so my overall base case is that you can get a decoupling for a significant period of time, but essentially what the hash rate shows is one, that it's profitable, and two, that the large publicly traded miners and the private miners are still have long-term confidence on Bitcoin. In addition, more of them have policies of permanently hodling their Bitcoin that they mine rather than selling it into the market. And so you generally see miner balances continue to go up. And that's one of the supply side characteristics that I described before, where right now you have very weak demand for Bitcoin, but you also have a pretty tightly held supply of existing holders and miners and entities in the space.
Okay. All right, perfect. Lynn, let me just piggyback off of what you said and go on to this chart now. This is something that you sent me earlier offline. It shows a 1-year HODL wave indicator. Now, what this indicator shows is the percentage of all Bitcoins that have not been moved from one wallet to another for at least 1 year. And we can see that coinciding with the Bitcoin price cycle. How are you interpreting this chart, Lynn?
So generally right now, basically when you have those very big bull markets that I'd previously described generally happen on risk on environments, so rising PMIs and just generally positive liquidity conditions, you start to get long-term holders sell into that strength. Many of them are up 5x, 10x, 20x on their holdings, and they start selling into that strength while new demand comes into the space. And so you get that the percentage of Bitcoins that have not moved on chain in over a year begins to fall. And then it starts to kind of enter a bear market. A lot of those long-term kind of high conviction holders, they no longer want to sell at those prices. And so they continue holding. They don't par with their coins. They continue dollar cost averaging in many cases. And so you get more and more of the coins held by strong hands. You get a shift out of like the fast money leaves the space, the strong hands take over, and that eventually contributes to the next bull market because it basically takes more and more of the supply essentially off the market. Those become illiquid coins that are not willing to move unless, say, price goes up 5x. And so that kind of sets the floor. And then historically, when you have rising PMIs and when you have a halving, basically you have a couple catalysts come together, you start to get a supply-demand mismatch. And so basically what we're seeing now is that it's showing typical behavior being midway through a bear market. And so basically, if we consider February 2021 to be the peak, even though we had hit nominal highs later. That February peak was, most indicators suggest that was kind of the real peak in terms of enthusiasm, and that ever since then we've been in this kind of bear market, and I think this still has time to grind through, but we're already kind of in kind of the challenging part of it.
Gareth, I have a chart for you. So I've been getting this a lot from viewers and people that I know, that Bitcoin is simply a leverage play on tech stocks. Now, this chart shows Bitcoin in the orange line versus the QQQ ETF, which tracks the NASDAQ 100 index, the largest tech stocks, the NASDAQ composite. Now, you can see a pretty close correlation. Is this indeed representative of the thesis that Bitcoin is simply just tech stocks with more leverage? How are you interpreting this chart?
Yeah, I mean, it at this point in its existence, I think that's how you have to take it, right? So it even leads the tech stocks, and you saw it leading there with a bigger decline. We've seen that, and the reasoning behind that is because at this point, it's treated like a risk on asset. So when you have people de-risking, as soon as the Fed was starting to expect to taper, you saw Bitcoin starting to fall because it was the riskiest of the risky assets. And now what we've seen is it kind of be a chain reaction, right? So Bitcoin's fallen, 30, 40, 50% at this point. And now you're starting to see some of these secondary kind of smaller tech companies get demolished. You have Peloton down 80%. You have some of these other ones as well down 75 to 80. And now you're just beginning to see stocks like Microsoft, which are kind of like the purebred, the thoroughbreds out there, they're starting to roll over. So it's kind of like a chain reaction where I think it makes sense. Now, down the line, I do believe that at some point when you have more acceptance and more people in the space of Bitcoin, it will actually be more like a digital gold. But right now, to me, it's very much like that, where it's just basically treated as a tech or risk on asset.
All right. Now, before we can
just to comment real quickly, I don't disagree with that at all. One thing I'd point out, NYDIG did a chart analysis a while ago showing the correlation with equities. And generally it had a somewhat spotty correlation with equities for a long period of time, from like 2011 to 2019. It's had higher positive correlation since March 2020. Basically, I think you've had this kind of pro-stimulus environment. A lot of assets became more correlated. It has been treated as a risk-on asset for most of its lifetime. If you chart recent Bitcoin action compared to, say, the 10-year Treasury yield, there was a correlation where generally the 10-year would rise on risk-on conditions and Bitcoin would also rise on risk-on conditions. And recently you saw that sharply diverge, kind of like the hash rate chart where, basically 10-year yields went up and Bitcoin has been struggling. So you can have these correlations that seem like they're working for a while, but then some regime shift happens and those correlations can very suddenly break down.
Well, just to your point now, Lynn, I want to show this chart here. This is the area chart here shows the 100-day moving correlation between Bitcoin and the S&P 500. Now, it would seem that just by looking at this chart, the positive green areas indicate a positive correlation, the negative red areas indicate a negative correlation. And so, like you said, Lynn, the correlations have been spotty over time. But what's interesting here is once you plot the blue line, which is the Bitcoin price, and you overlay it, you start to see when the correlations become negative and when the correlations were positive. It seems like when Bitcoin is rising, the correlations are inconsistent. But however, whenever you have a big drop in the Bitcoin price, that seems to correlate with the drop in other assets. In this particular case, the S&P 500. In other words, when the Bitcoin price drops, it's usually coupled with positive correlation with the S&P 500. Do we then say that, well, Bitcoin and the S&P 500 stocks rise independently of each other, but they always fall together, so Bitcoin really isn't a diversifier? Can we make that kind of argument?
Yeah, I wouldn't really consider it much of a diversifier in terms of basically changes over time. I think it's only a diversifier when you take into account true tail risks in the market. Basically, I think that eventually you can get decoupling from certain events occurring, but that on a trading basis, it's not really much of a diversifier because it does tend to go down when liquidity is weak and when risk on assets are in general doing bad. I consider it more of like a macro investment for its properties, its fundamental properties.
And Gareth, what about you? If you had to trade,
I'm right. Well, say it again.
I'm just saying, if you're trading stocks, which I know you are, and you're trading Bitcoin as well, how are you playing those two? What is the relationship between stocks and Bitcoin for your portfolio?
Yeah, so I mean, the relationship is absolutely, connected there. So for instance, I was starting to inch into various tech stocks the last couple of days that had been beaten down, just as Bitcoin was hitting my major support on the technical basis. So it's basically, in all fairness, you're not diversifying at all when you're investing in tech stocks as well as Bitcoin. I mean, there's different degrees of tech stocks, like a Microsoft versus a mid cap or something like that. But for the most part, they're absolutely coordinated. And you have to be careful as such, because if things start to roll, I mean, it's going to roll together.
All right. So you've talked about your medium-term outlook for Bitcoin. Before we move on to another topic, the audience, you are welcome to submit your own outlook on Bitcoin, and of course, let others know that you're watching. And we'll get a poll, and we'll see what the sentiment is from the audience. So now, I'm just moving on to the altcoin space. I know, Gareth, you mainly cover Bitcoin, but if someone were to ask you, Gareth or Lynn, what is the most undervalued or overvalued crypto, how would you answer that question?
Oh my goodness. I mean, overvalued. I'm going with Dogecoin personally. I just can't get over the fact that it's for me again. Digital currencies are created with the idea of at least scarcity. That's why I invest in Bitcoin. The idea that there can only be 21 million mined, and the fact that 10,000 Dogecoins are printed every single minute. To me, it takes away that reason for why I would invest. Now, granted, you have certain ones that are used for transactions. Solana is really impressive in that respect. So there are different ones like that have factors and reasons to invest. But for me, I'd be Dogecoin would be the one I would stay away from. And then, actually recently Solana dipped to $80 and I did a little buying right in the, in that area.
Okay. And Lynn?
So I would fade anyone that's based on a meme. But its fundamentals are inherently faddish. So that would include Dogecoin, any of the other dog monies that are out there, any of the ones that are based on memes. More broadly, I think that every cryptocurrency outside of Bitcoin has a lot more risk than Bitcoin, in the sense that they are generally have a lot of attributes of unregistered securities, essentially, that basically the SEC is exploring to what extent the ecosystem, a lot of those projects pass the Howey test, meaning that they raise capital with the intention of improving and increasing the value of their tokens. which means that they are securities and many of them did not register as such. And so there's regulatory pressures. And in addition, I mean, if you look at the long history of Bitcoin's existence, generally you have these waves of altcoins that do well during Bitcoin's bull runs, but they're rarely the same altcoins that stick around and do well in the next Bitcoin bull run, right? There's only been a handful of ones that actually stuck around for a few cycles. And so generally you're really kind of going against the odds of picking one of the thousands of cryptocurrencies that has staying power for more than a trade. And so for the vast majority of people that are not professional traders or just, putting kind of casino money speculation, you can treat them as lottery tickets. You can treat them as tradable, securities. But I would just be very cautious for people that are, say, trying to do something like HODL Dogecoin. I think that doesn't end well for most of the members of that.
Okay. Now stay tuned for the end of the interview because we are going to reveal your top trades or top most bullish trades for this year. I want to move on to stocks and the broader macroeconomic landscape now. I'm just going to start with this question. Are we going to see a major market crash this year? Gareth, let's start with you.
I don't know
you've
about a
been
major...
bearish for a while, but yeah.
Yeah. So, coming into the end of the year, we talked and I was very, very bearish. I had that upsloping trend line channel that I said would break, and it has broken to the downside. And one of the issues I have with the market, and this is why I'm still bearish, even though I expect a small market bounce here, is that if you look at the trend that started after COVID, so after March of 2020, the vertical nature of it is so much more vertical. It's basically the market on steroids because of what the Fed did, because the government ended up taking on tons of debt, sending checks to Americans. You had all this kind of stimulus jumping in the market, and it pushed valuations up so fast. If you go to the longer term trend of the market going back to 2013 and you connect the highs, that level is that longer term trend, and it is a lot lower. So I still think the market has downside. I think you'll get down about 20% on the S&P this year at the very least. I think NASDAQ could do 20 to 25, maybe 30%. But again, this is getting into Fed stuff, which we'll talk about in a little while. I personally think the Fed won't let the markets get too crushed because it will raise unemployment, which then deals with their dual mandate, which means they're going to have to come to the rescue. And so again, I honestly don't even think the Fed's going to raise 4 times like the market is anticipating. I think the market won't let them. I think, as much as they want to be hard-nosed on the market and be that adult in the room, the markets will create a situation where the Fed has to back off.
Okay. And Lynn, your view on markets?
Yeah, so there's basically, if you look at Wall Street forecasts of year-end S&P 500 targets, there's no correlation between what they forecast and what actually happens. And I don't consider myself any more of a forecaster or crystal ball reader than them. So I don't really give year-end targets or specific drawdown levels. What I do say is whether or not I think the risk, basically what is the overall kind of balance between risk and reward. And since December, in my research service, I've been cautioning, basically pointing towards defense for a few reasons. Basically, we're starting to get the PMIs rolling over. The fiscal stimulus Build Back Better fell through. So we're looking at, a period of the Fed tapering their asset purchases, lack of ongoing fiscal stimulus, and PMIs rolling over. You also have things like the copper to gold ratio, kind of showing flagging momentum, after a long period of copper outperformance, it's kind of shifting back to neutral in gold's favor. And so a lot of those indicators suggest a risk-off environment for 2022. But that could take the form of some people calling for a crash. I don't rule that out. I think that also can just take the form of a choppy, sideways, grinding market, right? So if you look at these indicators over the past decade during this kind of structural bull run we've been in, those risk-off indicators, instead of having a crash, they'd have this kind of choppy, more volatile, sideways type of S&P 500 action. And so I have little way of differentiating between which one of those outcomes occur. You could even get up, a positive year, just at a slower pace and a kind of a zigzag way of getting there. So I don't have a specific target other than I am considering 2022 to be a more challenging and riskier year than the prior 2 years, and I think defense is warranted.
Okay, well, just on interest rates, Gareth, you said that we could not see, or we may not see 3 to 4 interest rate hikes, which is what the markets are pricing in. Why? I want to hear your rationale here.
Well, it's just looking at the Fed history, number one, right? So in 2018, the Fed tried to be all strong-willed and raise, interest rates. The market threw a huge fit, dropped out 20% in 6 weeks, and the Fed, before you knew it, was lowering interest rates. So as even though granted inflation wasn't an issue there, the question is, okay, well, if inflation starts to come in, which as supply chain issues kind of get resolved, you assume inflation will come down a little bit, let's say 5 or 4%. I still don't think it's going back to 2% for a decade or more. But you have to say to yourself, well, what if the markets drop 30%? What if the markets drop 40%? That wealth destruction, which has created this market that has the economy has done so well off of from that wealth effect, gets demolished. And all of a sudden you see unemployment rise as people buy less goods. The companies have to do layoffs and so forth. And if now you have an inflation, let's say at 4% or 4.5%, but the unemployment rate spikes to 8%, are you really telling me that the Fed isn't going to back off? They're still going to say, no, I have to raise 4% or interest rates 4 times. I think the Fed, again, is going to get pressured, probably politically pressured if inflation comes in. And also, I just don't think they've ever shown that they've had a real backbone since the dual mandate was introduced.
Okay. Well,
to echo that, forward indicators are showing that CPI, and I've been on the inflation camp. You know that I've been talking about, being an inflationist for a while. We're seeing signs that by the end of this quarter, a year-over-year CPI might be rolling over and declining somewhat. So I think we're going to peak in this 7 to 8% area and then probably start to head a little lower. I agree. I don't foresee it going back to 2% anytime soon. But I do think that it's potentially topping out. Unless we get an energy price spike or something. So there are scenarios that I can see where that stays high, but absent those scenarios, I think we're getting lower. And the Fed historically has a really tough time hiking rates into a declining PMI, a decelerating economy. And so I'm also taking the under on the Fed's ability to tighten. I think that they're going to tight for a period of time. I would caution too much against, the equity market is one of the things they watch, right? So people often say that, if the equity market goes down, the Fed has to stop. I think there are more kind of salient indicators to look at, like credit markets. So in 2018, for example, the S&P 500 went down 20%, but the much bigger problem, the bigger part of the iceberg under the surface was that credit markets froze for 6 weeks. No junk bonds were issued for 6 weeks. And that's a more imminent problem that kind of forced the Fed to pull back. So I would look at credit markets and generally kind of signs of economic deceleration. Those are the things that would kind of force the Fed's hand more so than just equities on their own.
Just on that note, Lynn, before I jump back to Gareth. Okay, so Lynn, what is the relationship between yields and stocks? That's the first question. And the second part of the question, 2-part question, suppose the Fed doesn't raise rates. Just hypothetically, suppose they don't raise the Fed funds rate. Can we still see nominal yields rise?
So basically, there's different market regimes where those correlations can change. And so in highly inflationary regimes, generally when yields go up, it's bad for stocks, right? But in disinflationary regimes, generally because these large pools of capital can decide to buy more stocks or buy more bonds. And so generally you see bond yields go down during risk-off environments. So basically yields go down and stocks go down. Whereas during more inflationary periods, you tend to have the opposite.
So which regime are we in now? Because all throughout last year, throughout most of 2020 and last year, we had, as this chart shows, both the stock market, as denoted by the blue line, and yields going up at the same time. Now, ever since November, that correlation has reversed. So now the stocks are going down while yields are rising. Do you think this relationship will hold throughout the rest of the year? In other words, if yields rise, are we going to see a stock market decline?
So I think the challenge now is that we are in a more inflationary regime. The market's kind of been conditioned for that. I think going forward, once CPI year over year, if that does roll over, it's hard to I don't have a strong opinion on how the market's going to interpret that because, for example, on one hand, you'd have decelerating inflation. On the other hand, you have decelerating from a very high level, a 7% level, compared to bond yields that are very negative on real terms. And so there are some analysts out there, like Joseph Wang, for example, that have been talking about a potential supply-demand issue in the long end of the curve, especially if certain policy errors occur around SLR or the way the Treasury issuing too many coupons compared to bills. And so I think that there's a huge range of factors that can determine whether or not that correlation consists. And so it's not something I have a high conviction view on, but there are indicators that I'm looking at around that question. I think it's a really key question to focus on. And I'm not particularly, enamored by buying the long end of the curve here.
Gareth, what's your view on the Fed and inflation and how that's going to impact stocks?
So yeah, I'm in the camp where the inflation likely does come back in, as I mentioned. So I don't think it's coming back to 2%, but I think that for the most part, that's going to take a back seat. The question again is, how does it impact the markets? The markets, again, it seems to me like you're going to likely see yields get up to about 2.25%, and then the Fed's going to probably have to put the brakes on interest rate hikes. So I'm in that camp. I do think you see more volatility before the Fed does that. And I think the markets are really queuing off. One of the things that struck me is that if you look at when the equity markets, the NASDAQ really started to collapse, the S&P, it was when the Fed came out and said, hey, listen, we're not only going to taper, but we're going to raise interest rates and we're going to roll off our balance sheet. It was that roll off the balance sheet that really surprised the market. And it makes the market think that the Fed didn't have any clue whatsoever, right? It's that kind of surprise. And so I think the Fed has to reestablish their credibility to some extent. I mean, think about how many times the Fed has been wrong. And these guys are supposed to be the smartest in the room. They said, oh, it's transitory. It's transitory. Don't worry about the inflation. And then, myself included, amongst many people were saying, listen, it's not transitory. And all of a sudden now they're saying, oh, it wasn't transitory. Whoops. And again, for the market has been guided by the Fed, thinking the Fed has always understood and knows the right path. And I think the market's beginning to question that. And it's going to be interesting to see, can the Fed get their credibility back? Can they get inflation under control without tanking the economy?
Well, let's ask the audience, what do you think? Write your comments down below. Do you think inflation is transitory or persistent? Is the Fed able to combat rising inflation? Write your comments down below. There's almost 3.5 thousand viewers right now concurrently. That's amazing. Thank you both, Lyn and Gareth. And thank you to our sponsor, of course, Coin Payments, for bringing this event to almost 3,500 viewers live right now. I'm going to go back to the US dollar. This is a question or a topic that I've discussed many times in our show. And several economists we've spoken to have said that in the history of fiat currencies, if you look back at hundreds of years, the history of fiat currencies tell us that most fiat currencies devalue to zero. By 99%, almost zero, down to zero. Now, the US dollar, they say long-term is no different. First of all, do you agree with this view? And suppose we do get dollar devaluation, where do we go? Lyn, I'll start with you.
Well, it already has lost 90-some% of its power since inception. So it's already in that camp. The question is, will it happen? Will it continue to happen? I think just like any other fiat currency, it's going to devalue over time. Whether or not you're comparing it to real assets or other currencies is kind of a separate topic. So you can have a declining dollar index. You can have a rising dollar index, meaning it's strengthening versus other currencies at a time when all currencies are devaluing versus, say, gold or real estate or stocks or whatever the case may be. My overall kind of base case is that in the next couple of years, we're probably going to enter a dollar bear cycle. It's something I continue to monitor, though. I think that, currency trends are not something that I want to stand in front of. It's kind of like standing in front of a freight train. So I want to see price action start to roll over. So it's something that I continue to monitor. Basically, there's a couple key variables to watch. One is things like rate differentials and quantitative tightening. So basically the things that the Fed can control. And that's why a lot of people are dollar bullish right now, because the Fed's kind of, talking about being hawkish, at least relative to, say, the ECB or the Bank of Japan, which are some of the big currency pairs. On the other hand, it's also dictated by capital flows, right? So if the Fed's hawkishness puts pressure on the NASDAQ, there's so much capital around the world kind of pouring into the NASDAQ, pouring into US tech stocks over the past several years. And if that capital decides to go into value, decides to go into other markets, you can get a dollar weakening period. And so I think overall, we're looking at a somewhat more weak dollar, compared to, say, I think it could take some pressure off of emerging markets. But it's something I continue to watch for price confirmation. And basically, when the dollar kind of goes up sharply to the upside, you start to get indicators generally that the Fed might end up having to back off. I think a big surprise to the markets would be that if say both Gareth and I are right, that the Fed is unable to get the hawkishness that they've described, right? If the economy continues to decelerate and they have to back off some of their tightening plans, you could get a big trend shift in the dollar as markets begin pricing that in and potentially rotating capital elsewhere.
Gareth, dollar devaluation down to zero, could it happen?
I mean, anything can happen, right? And I think Lyn's 100% right that the dollar should have a weakening period. The way I would project it and forecast it out is that the world is watching the Fed, right? So we have inflation, how it is, and if the Fed is unable to be as hawkish as she said, then it's going to send the signal out to the world that the Fed really has lost control and they're never going to be able to be the tightening player in the room that keeps the dollar strong. And if you look at reserve currencies throughout history, whether it was, France was the reserve currency hundreds of years ago, England was, and now the US since I think it was 1920, reserve currencies don't last a whole long time. I mean, 100 years, 110 years, somewhere in that vicinity. And so we're kind of approaching that at this point, getting to that point. And if you look at China, I've been saying this for the last year, ever since China introduced the digital yuan, China is this Belt and Road long-term player. They want the reserve currency of the world to be the digital yuan. They introduced it. They're going to start pushing it more and more. And I do think that at some point, if the Fed loses enough credibility, you will see investors flee the dollar. And eventually that will drive the price of the dollar down and pretty quickly and fast. Yeah.
One thing worth pointing out is that in World War I and World War II, the UK went into that period as the global reserve currency. You had the rising power, which was the United States, and you had a similar dynamic where the world, the world currency UK, they were running these structural trade deficits while the United States was running structural trade surpluses. But after you had the event of those wars, and you had all currencies devalue versus gold. The UK devalued as much or more as many other currencies. So, for example, they devalued more than the dollar. And so being a world reserve currency, when the regime shifts, does not protect you from currency devaluations, just like other currencies.
Mm-hmm. So I guess people buying stable coins tied to the US dollar, tied to potentially any currency, I mean, is that just a futile exercise? For the long term, I guess. The short term, you can farm yields. What's your take?
Yeah.
Well,
sorry.
Go ahead. No, go ahead.
I was just going to say, I mean, for me, the tethers of the world, I mean, it's great for transactions, right? But aside from that, I mean, you're basically holding something that's going to mirror the dollar. So as a long-term safety play, I don't see it as such.
So I'm bullish on the proliferation of stable coins. I ever since January 2021, I've been saying that market's going to get a lot bigger. And it did go from something like, 40 billion to like 140 billion in a year. And I do think that market's going to get bigger over time. There are use cases. So I'm not bullish on the dollar, but for example, if you were in Argentina or Venezuela or Turkey, the dollar is pretty attractive. Stable coins are attractive to a lot of emerging market users. And they are also serving as a unit of account for offshore cryptocurrency exchanges. It used to be Bitcoin. With the invention of stable coins, they can use those. And so, because I don't think the dollar is going to zero overnight, right? I don't think we're going to be here a year later and talk about how the dollar is done now, right? So I think this is going to be a long-term issue of just ongoing devaluation. And so I think that stable coins are going to play a role going forward. I think they're just as prone to devaluation as the underlying currency behind them. So I think that they can be a low volatility way of transferring and temporarily storing value, but they're no substitute for things like Bitcoin or gold or hard assets in general.
Perfect transition. We're going to ask about gold now before we open the floor to the audience. So let's talk about precious metals for our last segment before we go to Q&A. Gareth, you have said that gold will be the best performer of 2022. I'd like to hear your rationale for this.
So it's looking at a couple things. Number one, being a technical chartist, that's the chart is the first thing I go to, right? And you look at the chart, you had this mega run from 2018 in gold all the way to the highs in 2020. And since then, you've stayed in the upper range. I mean, even though, so many people have said, oh, gold hasn't done anything, it's dead. But really what it's doing is digesting that move from the lows of 2018 to 2020. So that digestion period is looking like it's coming to a close. We're borderline breakout, short-term breakout here on the chart. And I think, again, you have a situation where Bitcoin and cryptos are now entering a bear market. It makes them less attractive. I think money, in 2021 flowed away from gold into cryptocurrencies because it was the hot place to go. Now people are starting to realize that at this stage of their existence, they're not really a protection against inflation or anything else. So I think that puts the onus back on gold to be a better performer. So again, between charts and just looking at what is going on, I think you have a very good bull case for gold. And overall, remember, I'm thinking that gold will be the best performer. But to be the best performer, when I'm thinking that the NASDAQ, S&P, and Bitcoin are down for the year, it doesn't also say it has to do a whole lot, maybe even just stay here or go a little bit higher. But I ultimately do think it's at least going back to the 2020 highs and possibly as high as about 2,600 by year end.
Okay, Lynn, what's your view on gold?
I'm pretty bullish on gold. for brief history, I turned bullish on gold in late 2018, early 2019. And in my August 2020 newsletter, I got more near-term cautious on it. I said basically my bullishness has shifted to Bitcoin in the near term, and that I was, I think that gold had played out the first part of its kind of run here, but I was still kind of long-term bullish. And then for full, in March 2021, I started to get bullish again, which was kind of a false start, right? So I mean, analysts like to talk about their wins. I mean, sometimes things don't work out the way I expected. So gold, I started to see signs of a breakout, and instead it just kind of rolled back over and kept going sideways. So it didn't have like a breakdown either, just kind of continued its sideways trend. And then starting a couple weeks ago, I started to see a second attempt here at a gold breakout, and I think this one probably has more legs to it. And I'm starting to see it confirmed in price. And so, for example, with a declining PMI, basically risk off of environment, gold kind of finally has its chance to kind of decouple from S&P 500 to the upside. And so that combination of decelerating economy, and if the Fed indeed is unable to be as hawkish as is currently priced in, that could be a bullish catalyst for gold. And so overall, I do think it's a positive risk reward here. In addition, we're seeing just price confirmation. The S&P 500 priced in gold has been rolling over, and giving some pretty bullish signals in gold's favor. So I think that as a defensive play, as part of a portfolio, I am bullish on gold for 2022.
Okay. If I could just jump in here too, there's one other thing I'd like to mention about gold is I love to compare gold with the inflation periods that we're in now versus the 70s and 80s. And what's fascinating is that in the early 70s, before that high inflation hit, gold had this beautiful run from about $50 to $175. And in 1975, when inflation was roaring in the US, gold actually had this period of consolidation that lasted 1 to 2 years. Now, by the late 70s, 77 or so, you started to have a mega move where gold went from about $100 all the way up to about 800 or so. So just keep in mind that a lot of people have said, well, you have inflation at 8%. Why isn't gold ripping to the upside? Well, there's a certain amount of price action that it takes for that metal to get the money flow to go in and start chasing it higher. And it's absolutely, in my opinion, replicating the price action from the 70s into the 80s.
I agree. And it's hard to have gold rally a ton when other risk assets are rallying as too, because you can say, well, why would I buy gold when I can just buy the S&P 500? That's going straight up too. And so it's really once the other things start to encounter weakness, that people can look around and say, well, what's doing well? And one of them is, I think in this declining PMI environment, is gold.
Okay. Perfect. Now, let's open the floor up to questions. This is the moment you've all been waiting for. By you, I mean the more than 3.7 thousand concurrent viewers online right now. We've had more than 75,000 playbacks since the beginning of this stream. Thank you all for joining us. Thank you, Gareth and Lynn, for staying this long. We're going to open the floor up to questions. Before we do, hit the subscribe button. Don't forget to subscribe to our channel. And thank you once again to our partner and sponsor, Coin Payments. So, opening the floor up to questions, we have one from Robert Rasny. He said that analysts are forecasting a severe crash ahead, some even in this year. We've addressed crashes earlier, but this is an interesting question. He said, I have a well-diversified portfolio. Should I stop buying stocks and accumulate cash instead? So both of you have talked about gold as a store of value. Is cash better than gold? I'll start with you, Gareth.
Not for me. So cash isn't better than gold for me. Obviously a well-diversified portfolio is important. And I think it's important to have some cash on the sidelines, right? And most investors don't understand that when you have cash on the sidelines, it actually allows you to take advantage of great opportunities, right? If you're all invested, what are you going to do when the next great opportunity pops up? And we don't know when that will be. So having some cash, yes. But overall, if I had to choose between cash and gold, I would go with gold.
Lynn, do you like cash?
I don't disagree at all. I think basically gold is primed for this year, I think. But everything's probability weighted, right? So you could have gold surprise the downside. There's a lot of catalysts that can affect it. And so I do think that having some cash as well is useful. There are some kind of liquidity shocks that you could have where cash would outperform gold for periods of time that you could then rotate into either gold or other assets that declined in that risk-off period. And so I think that it does serve as a useful purpose as cash or T-bills.
Okay. We have one from Audrius Baranovskaus. Could the market rally off of a Fed hike? Given that the hike is priced in, or is it? and the market is waiting for the Fed to act. So market rallying on a hike. Interesting question. What do you think?
Who do you want to take that?
I'll jump in.
Yeah.
I'll jump in. Basically,
Okay.
so I think that you have to look for dovish or hawkish surprises, right? So the market has priced certain things in. If they say hike, but Powell talks about how they're noticing a decelerating economy and they're going to be very data dependent, and he placates the market, then you indeed could have a rally on a hike. Historically, hiking periods were actually bullish for the stock market, because the only time they're able to hike rates is when the economy is strong enough to absorb those rate hikes, right? So it's generally during rising PMI environments, periods of economic acceleration. And so it's not that hikes are good for the stock market, it's that both hikes and good stock market performance tend to occur during periods of economic acceleration. And the challenge now is that because inflation's high, they're stuck trying to talk about hiking into a potentially decelerating economy, which is a much rougher period for stock market. So I think you absolutely could have a period where they do a quarter point hike, and the market is happy because things they said indicated that they're maybe considering backing off or something like that. That you either did not surprise hawkishly or you possibly surprised dovishly.
Yeah, and I would concur with that. And I think to understand, right? So the Fed coming into the announcement tomorrow, they're not going to hike, right? At least I'm not expecting that. They're going to continue their tapering. I think they'll talk about their projections for when they're going to hike, and that's what the market will cue off of. And I think the Fed is getting a lot of, whether it's Russia and Ukraine as potential risks or inflation, coming back in. There's so many things, or the stock market just dropping as much as it has this quickly. There's going to be a lot of reasons for Jerome Powell in his press conference to try to soothe the markets. Whether or not it works, does the Fed have the credibility at this point? That's what we're going to find out.
We're now at 3.8 thousand viewers. Hit the subscribe button. Don't forget to invite your friends. Let's see if we can get to 4,000 people before the end of the stream. And of course, submit your questions. Here's a question from Jared Piven. Where does the gold-silver ratio go from here? Does the ratio move in gold or silver's favor this year? Lynn, what do you think? Let's start with you.
No firm view. One thing I'd point out is that usually in kind of inflationary risk-on periods, silver tends to outperform gold, yes. Whereas in more kind of declining PMI environments, it tends to be more in gold's favor. There are exceptions to that, and so I would have less conviction about silver this year than I would on gold this year. But I'm not going to plant a flag on that. But basically, I think my overall view is stronger for gold.
Gareth, you like gold more or silver more this year?
Yeah, I just like gold more, just from the aspect of with the Fed tightening and gold having the industrial side to it. It just makes me a little bit cloudier on what silver can do. I think long term, I love silver just like I love gold. But in the short term, over the next 6-12 months, if the economy does slow, how much impact on silver does that have versus gold?
We have a question here from Onion Farmer. Onion Farmer says, get price projections. What are price projections? It's what the people want. So we've talked about Bitcoin. Let's talk about gold. Gareth, your long-term gold price projection, how high can we go or low?
Long-term. So that's such a gray area. All right. So my end of year target, I would say 2,700, maybe best case scenario, 3,000. Further out, I do think it's got 5,000 on it. I think you will get a major bull run like the late 70s into the early 80s happen, and you'll probably see 5,000. But again, I honestly don't know if that's 3 years out or 5. I mean, it's so hard to know.
Lynn, I know you don't give price projections, but let me ask you this broad question. Look, in the past, we've seen gold rally more than 50% from its previous peak because of central bank monetary stimulus and the expansion of the Fed balance sheet. Now, we've seen an expansion of the Fed balance sheet to an unprecedented degree. Why has gold stalled at $2,000?
Well, one was that real rates stopped getting more negative, at least measured by the TIPS market. That's part of why I became more cautious on gold in August 2020, is that we started to see the 10-year yield compared to inflation expectations, which are different than actual CPI. Somewhat of a manipulated metric, but still, that's what it follows. And so you started to see that kind of trend sideways instead of down. And one thing I point out is that gold had a pretty big rally in late 2018 and into 2019, and that was when the Fed was shrinking its balance sheet, right? So it's not like it needs that. It's really about partially declining real rates, what other risk assets are doing, whether they have a declining, whether you have to decelerating economy or not. And so one thing I noticed is that we with this recent rates rally, you've seen an uptick in real yield. So they're still negative, but they had a pretty sharp move up, and gold completely shrugged it off, which is a really good sign. When you start to see an asset that generally has a correlation with something and it starts to kind of shrug away from that correlation, it starts basically you're rallying in the face of bad news. And generally that's what characterizes bull markets, that you rally on good news and you don't really sell off much on bad news. Whereas bear markets do the other thing, basically that good news fails to pump you up and bad news sends you down. And so gold is starting to show signs of shrugging off things that are normally kind of challenging for gold. I think it's seeing through the fact that the Fed's probably going to have trouble hiking into a decelerating economy. It's also possibly sniffing out weakness in the dollar ahead. And so I think overall, my long-term view is that gold forms kind of this big cup and handle pattern that a couple of people are pointing to, where it peaked in 2011, 2012, and went through this downtrend, kind of rolled back up, kind of reached slight new highs, and then it corrected and kind of had this kind of rolling flat period. My overall base case is that we roll up and eventually break out to new highs. I don't have a firm target by year end. There's so many variables that could go into that.
Sure.
And so I think 2,600 or higher would probably be on the higher end of my base case. But I tend to have conservative targets in general. And so overall, my overall view is just basically I think we grind higher and eventually get to new highs in the years ahead.
All right, here's a question for the both of you from Chairman Kilhan. Are emerging markets a safer alternative to U.S. equities? So let's start with you, Lynn. You brought this chart here. I'll just show this chart on the screen. Dedicated EM funds market share. Let's explain what this chart is showing and then give the audience a review on EM.
So what this chart is showing, particularly the blue line, is that investors have a very, very low allocation to emerging market funds. And that's really the whole world. Basically, global investors, ex-US investors, are heavily piled into US equities. And American investors are underweighted historically into foreign markets. And that is very similar to what happened in the 90s going into the dot-com bubble. Basically, everyone piled into US equities. And so we see similar dynamics today. It goes through these big cycles. And this is part of why I have a bearish dollar thesis, that we've already pulled in about as much capital as we can from the rest of the world. You can maybe get a little bit more, but basically we're kind of scraping the bottom of the barrel here in terms of how much more capital we can get on one side of the boat, all stuffed into one market. And so as we look forward, I am more bullish on emerging markets. If I were to describe gold as my defensive trade going forward, I think that Chinese and Brazilian equities are my higher volatility bullish view for this year and then probably continuing next year. I'm basically constructive on ex-US equities, especially value-oriented equities, and especially emerging markets.
Gareth, let's focus on China. I know you've talked about China before. This is a chart that I like to show. So this is just an index for Chinese stocks. The MSCI China ETF declined substantially this year. What's your view now? Can it recover? Or
yeah, so it's these. Believe it or not, these are my biggest long holdings right now. Is in China stocks. The valuations are incredible. Obviously, you have the risk with regulation there, but it does seem to be waning a little bit in terms of the constant hit to the Chinese stocks. And I think if you just look at like the Hang Seng is trading at levels it was trading back in 2007. If you look at the KWEB, which is the internet ETF for China stocks, it's trading back at levels back in 2013 and 14. And then if you look at US equities, just like Lynn said, there has been just, all the money around the world came to the US. US investors went into US stocks. And at some point, you have to have that kind of unwind a little bit. So you should see a very nice move up in those markets. In addition, China doesn't have to worry about, the Fed is tightening. China isn't looking like it's on that same path. So you have a looser environment there for interest rates and for money policy. And I think that's also going to be bullish. So you should see a reversion to the mean, if you will, where US stocks may come down. And then you probably have these foreign markets. I also love South American stocks just the same like Lynn.
Okay. Yeah, one thing is going back to the PMIs that I keep bringing up is we see the United States and a lot of other developed countries rolling over in terms of PMIs. China and Brazil already rolled over, and they're actually showing signs of maybe stabilizing and rolling back up. You have Chinese credit impulse pointing upward. you have Chinese central bank easing, and then you have their PMIs are already not great, and kind of, if anything, pointed sideways to up. And so both of those, I think, are bullish catalysts. Also for Brazil, they've had, they spent all last year hiking their interest rate, trying to deal with inflation. And their inflation started to show signs of year-over-year peaking. And the last time that happened was in 2016, which marked the ultimate bottom of the Brazil ETF in dollar terms. And so if inflation in Brazil stabilizes and the central bank is able to stop hiking rates, and if you have a dovish surprise out of the Fed at some point this year, that's a very bullish case for Brazil. And so I am bullish on emerging markets broadly, and particularly those two countries. And maybe Russia, if depending on what happens with Ukraine, but that's too tied up in this kind of Boolean outcome of geopolitics. So right now, kind of China and Brazil are the ones that I'm favorable towards.
Okay, well, what are the top geopolitical risks for you guys right now? Then you just brought up China, Ukraine. What else are you looking at?
So for me, I'm looking at I think the biggest thing this year in terms of markets is whether or not the U.S. economy decelerates, and what the Fed does if it does, right? So does the Fed back off and deal with markets in that way? So I think that's the biggest thing. When you look at geopolitics more broadly, we have elections later this year in the U.S. China has their National Congress late this year, which is the closest thing they have to elections. Basically, you have potential regime shift or regime continuation. That's what they're aiming for, is probably continuation. And that also plays into why I think Chinese stocks are well positioned, because it's like they got a lot of the pain out of the way last year, and they want this year to be a smoother sailing ride. They want to have a more formal launch of their currency, and they want to have things at least not falling apart when President Xi is probably aiming to get a third term, which is somewhat unprecedented in modern Chinese politics. They don't want their equity market just going straight down when he's trying to basically make the case for why he wants to stay in power. And so I think that overall that's kind of a pure stabilization. I also would be somewhat surprised if they do something with Taiwan in this year, but before that national Congress. I think after that it's a long-term huge risk factor, anything related to Taiwan. In the obviously Ukraine, Russia is a big deal. I generally incline towards taking the under on World War III, right? So I'm going to generally fade that. But I do think that you could have border incursions. I wouldn't be surprised. Right. And there's the tail risk for energy markets, right? I think that overall I'm an energy bull long term, even though the sentiment got a little bit one-sided in the very near term. I generally am bullish energy long term, and that's just like another risk that could happen. You could basically have something disrupt energy markets related to that area.
Gareth, I do want to get your view. I don't mean to interrupt, but Lynn, I want to circle back to what you said about Taiwan and China. Some analysts I've spoken to have said that the Chinese-Taiwanese issue, cross-strait issue, is probably the most significant geopolitical risk on the planet right now. If anything could cause World War III, it would be that. What do you think? Do you think China's going to invade Taiwan?
My base case is longer term. I would not be surprised if they do take Taiwan. And my base case was that the U.S. would not trigger World War III over it. I think that they would probably not intervene militarily if that were to happen. I think that China would only do it if they are sure that they could survive sanctions, right? So they want to have their currency in place. They want to be able to, basically the US's nuclear options, besides actual nukes, is that they can cut a country off the SWIFT system. And so there are countries like Iran that are, and Venezuela that are really vulnerable to that. North Korea, Russia has built a fortress balance sheet, and so they're more defended against that. And China is also trying to build a fortress balance sheet so they can survive being cut off from the SWIFT system. And so I think that basically after 2022, it becomes more of a risk. I mean, anything could happen this year. I mean, there's always a non-zero chance that something happens. But basically, the longer you go, the more it is possible for China to do it and to minimize repercussions. So I don't think that would trigger World War III, but I do think it is a very, very big long-term risk to monitor, and it has huge implications for supply chains and for recognition of say global reserve currencies and things like that.
All right, Gareth, your geopolitical
I
risk
agree
takes...
with the Taiwan-China situation. My interpretation is that likely Afghanistan's pullout by the U.S. emboldened Putin in terms of saying, okay, the U.S. isn't going to do anything militarily. I think then China is going to watch Ukraine and Russia, and they're going to cue off of that. So if Putin does invade Ukraine, then China will absolutely be hawk-eyed, zoned into what the U.S. does in response. I don't think you're going to get a big nuclear 3 point, World War III or anything like that. I'm in the camp of more sanctions, debilitating type things like that, because again, the U.S. population is not up for another world war over some other country at this point. So yeah, I'm in agreement. I think there's lots of geopolitical risk, but also remember that if Russia invades Ukraine, does it give the Fed the easy out of saying, well, we're going to slow down on our hikes? And does that then turn into a positive? I mean, if it's localized in Russia, Ukraine, it actually could end up being, after an initial shock, a positive for the stock market as well, or at least, a valid reason for the Fed to kind of walk back their hikes.
Okay. A few more questions on geopolitics, and then we'll circle back to Bitcoin and end it there. We have another question from Onion Farmer. Onion Farmer wants to know, why is gold now responding more to geopolitics? Good question.
Well, I think in general, people expect too much of gold from geopolitics. It usually has these daily spikes from geopolitics, but really it's about currency debasement and risk-off behavior, right? So basically, if gold has weak sentiment, real yields are negative, and then you get the decelerating economy, that's a great environment for gold. I think basically individual circumstances, these kind of headlines give gold like a positive day, right? But if you look back this history of big events, those generally don't necessarily trigger these long bull runs in gold. They just kind of have this kind of brief sentiment spike, and it's really about those economic factors that determine whether or not gold has a more structural, bullish or bearish outcome.
Gareth, interesting point. We had COVID last year. Gold obviously spiked because of a monetary stimulus, but do you think COVID played a significant role in gold's performance in 2020?
I don't. I'm in the camp that again, these type of events short-lived, and then eventually they pass, or the market looks past them, and gold reverts back to where it should be based on inflation and the currency. So yeah, I'm not in that case, and be interesting to see. And just David, not to bring up anything else, but I'm just noticing Microsoft getting slammed after hours on earnings. So something else to keep an eye on for a risk for the market tomorrow.
Okay, excellent. Well, we'll talk about that another time. Now, okay, we talked about gold, we talked about the markets, Bitcoin. There's a few questions on Bitcoin from the audience. Jonathan Shoehouse says, any thoughts on the energy usage of the BTC network and how that is sustainable into the future? If the price drops below the energy cost, does that mean the next stop for Bitcoin is zero?
The short answer is no, because there's a difficulty adjustment every 2 weeks. And so basically we saw this with the Chinese migration. Basically, a lot of Bitcoin miners came offline for geopolitical reasons, and the network slowed down somewhat. Basically, block times are supposed to be 10 minutes. They inch up to 15 minutes, 20 minutes. And then every 2 weeks, there's a difficulty adjustment that makes it easier to mine, and it resets it back towards that 10-minute average duration. And so the network is constantly adjusting itself to adjust for the fact that whether or not miners are joining or leaving the network. As for energy sustainability, Bitcoin uses something like 0.1% of global energy, and it also scales in a way that most people don't understand. Basically, energy the kind of the energy usage as a percentage of market caps, does not increase at the same rate, and that's because of the declining block subsidy over time. Basically, the Bitcoin network becomes more efficient as its inflation rate decelerates over time, with the only kind of flexible variable there being the fees, which are generally very low, a small percentage of the energy usage. And so I for people that want to look it up, I have like a 15,000 word article on Bitcoin's energy usage. You can just Google it. And I kind of walk through all the details of how and why Bitcoin uses energy and why it's not, I don't really view it as a problem. And my background actually is electrical engineering, and I actually find that aspect of Bitcoin very interesting. And there's a lot of kind of research on, and actually is now beginning to be practical applications of using Bitcoin mining as a load balancer. Basically, sources of energy production can use Bitcoin as a way to offload surplus energy, because any grid naturally has to produce more energy than it uses. Otherwise, if you turn on, say, a marginal computer, you'd have a brownout, right? So you have to have a flexible kind of difference between production and demand for that energy. And so you need kind of these flexible loads to absorb it. And Bitcoin happens to be one of the best ones available.
Okay. Gareth, I have a question for you. This is a question from, let me see here, DF, IMF global growth downgrade, question mark. So the IMF did downgrade the global growth outlook. Is this affecting your trades at all?
No. I mean, this is like Moody's doing their thing, and all the S&P downgrading and so forth. It's almost weirdly enough they always seem to come in too late on in the cycles. If anything, sometimes I'll use it as a contrarian view. At the lows of a chart, for instance. Same thing with analysts. And again, if they're getting away from the IMF, but for the most part, most markets adjust before all this stuff happens, right? Smart money is always ahead of this. And so you'll see the markets already reflected in the markets before anyone does it.
We're just about wrapping up here. So this was my final question to you. Somebody else asked this. From Japanese whiskey, which equity sector are you most bullish on? Let's start with Lynn first and then Gareth.
It depends on what you count as a sector. I mean, generally, I instead of sector, I would say I'm bullish on emerging market equities, specifically Brazil and China.
Yeah.
In the U.S., I've been, ever since December, I've been talking about this defense. I've been inclining towards, say, healthcare, for example. And I tend to pick out individual healthcare stocks more so than just buy the healthcare ETF. But in general, I do like some of the, and that's separate from the vaccine plays, basically just the diversified kind of blue chip, dividend paying, low valuation healthcare stocks that are rather economically, protected from these cycles. And so that's one that I've been liking, in the past few months.
Okay. Gareth?
Yeah, so same kind of thing. I mean, huge on China stocks as we've talked about before, David, in past interviews. And I think, again, keep an eye on the gold miners. I mean, if you want to look there, I think that's a great place to potentially capture some upside in the next 6 to 12 months. Same thing with gold. But again, for me, my portfolio is basically short US equities, short indexes, long emerging markets, and long gold right now.
Okay, we have one final question for each of you. Lynn, I'll start with you first. This one's from Clam Pizza. Clam Pizza wants to know if there is a resistance level that Bitcoin breaks that would cause Lynn to panic.
The short answer is no. There's no, I look at, it's not just price. A lot of people look at just price. I look at a lot of different indicators. I think that anyone who's investing in an asset as volatile as Bitcoin should have a position size that is appropriate. It's only a 13-year-old asset. There are also, there are tail risks that could cause permanent capital loss that you have to take into account in your position sizing. I think that's a low probability event, but it's something to consider. And then apart from that, there's, tremendous volatility in the asset. So we talked about some of the conditions earlier that I think could cause liquidations, right? So if you had, clear policy error, kind of liquidity freezes in the markets, credit markets freeze, I could see Bitcoin having a massive down candle, kind of like late 2018. So I can envision scenarios like that. I think, if you were to have, say, a coordinated US and European ban on it, or severing it from the financial system, I think that would slow its adoption and be a pretty major blow that period of time. I think that's unlikely again, but there are kind of these big risks I can paint for it. And I think the best way to manage those risks is to manage your position sizes. And for me, it's about monitoring the fundamentals.
Gareth, 1 minute left. Last question for you, and you'll close the panel for us. From Nia Ayasin, is it possible to be in a bear market for BTC and cryptos till the middle of 2023? So basically, crypto went until next year.
Yeah, I mean, if you look at past cycles, right? I mean, in 2017, you topped out, and then it was really about 2020 before you started to increase, see the price of Bitcoin increase. So I do think that if you look at past cycles, it's easily could be at least a year. Again, the best thing to do is always go back in the charts and look at history. It doesn't always give you, exactly what you need or what you want to see, but it'll give you a guide that can be followed for the next cycle. So I do think that's a possibility, and that's what I'm planning for. And I am looking to accumulate heavily when we get down a little bit more in Bitcoin.
All right. Well, that's all the time we have for. I want to thank you both again, Gareth and Lynn. Before we let you go, where can people find more of your work? Lynn, what's your website? Where can people find you on social media?
I'm at lynalden.com. They can find my work there. And on Twitter, I'm at Lyn Alden Contact.
Gareth?
Verifiedinvestingcrypto.com is my crypto trading website. And then inthemoneystocks.com is for stocks. And again, David, you did a great job. Thank you, Kitco, for throwing this event. It's been fantastic.
Our absolute honor to host two fan favorites at the same time. And thank you to the viewers. All 124,000 of you have at one point watched this. So we currently have 3.7 thousand concurrent viewers. Thank you so much again. Thank you for your questions and your comments and your submissions. And last but not least, thank you to Coin Payments, our sponsor, for bringing this wonderful event to the viewers. Thank you once more. Don't forget to subscribe to our YouTube channel. I'm David Lin. Have a good evening.